a 250 unit property in Central Texas. The day we went to close on it, I wired my $5.2 million in to the seller. Well, the wire never showed up. I had to come back now and say, hey, we didn't close. I'm sorry, but I'm going to do you one better. I don't know where your money is either.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. Hello and welcome to episode 243. What does it take to raise OPM, other people's money, in order to acquire larger real estate deals than you'd ordinarily be able to do by yourself? Should you be thinking about raising OPM in order to take your investing business to the next level? According to my guest today, it takes a certain type of person to thrive in syndication. And 40% of the people he's seen do their first syndication deal never do it again. That's why he wrote a book about syndication and its pitfalls called Syndicating is a BITC, rhymes with which, and other truths you have not been told. And today, Bruce Petersen is here to discuss these truths and help you figure out if syndication is a road you want to travel. Bruce built his Apt-Guy empire and wealth by syndicating over 1,100 units in real estate. And today, he's going to share his secrets to success with us right now. Bruce, welcome to the show.
Thanks for having me.
How did you get involved in real estate? And tell us a little bit about your first syndication deal.
So the way I got involved, it's, I guess similar to a lot of people, no background in it at all. I guess atypical. I worked for other people for a lot of years, right? So I'm 51 now. I worked in retail actually for 18 years. Hit a wall, burned myself out, and just walked away. I was a Dave Ramsey guy, so I believed in saving my money, living way below my means, investing wisely. So at the age of 43, like I said, I hit a wall, so I bailed. I just packed all my stuff up in a storage unit and drove around the eastern half of the U.S. for a month to a month and a half, trying to clear my head. I was a single guy, no kids, no girlfriend, nothing. It was just me. So I get back from that trip and think, okay, what am I going to do for the rest of my life? I'm only 43. I got another 60 years, roughly. So I just started doing a Google search and I typed in, not multifamily, but actually, real estate mentor in Central Texas, which is where I live. And a few people came up and I called around, checked into a few of them, and I found a mentor that would kind of walk me through the process. Again, I didn't know how to do it. I'd never done it before. I'd bought my own house before, but that's it, but never a rental. So I did that in 2011. I started getting educated. And then in 2012, I bought my first unit property, which is a 48 unit here in Austin, Texas. Back then, I paid $1.6 million for it roughly. And I raised $460,000 from other people and put $115,000 into my own deal first time out. It was a deal that I was comfortably the highest level investor in the deal. It was very important for me, having never done this before with no track record, no experience, that I was the largest investor. So that was the first deal I did, held it for a little over 2 years, almost 2.5, sold it. Now, this was a lot market driven, granted, but we recognized a 300% return on that first deal. And I've been off and running since. So
that was your first syndication deal. It was a 48 unit. Was that your first real estate investment?
Yeah, it's the only thing I've ever done. I'd never owned a single family rent home, no duplex, threeplex, any of that stuff. I went straight into apartments and I did my first apartment deal as a syndication.
So you jumped right in. I can think of all kinds of pitfalls and challenges you must have had to overcome, starting with raising money from other people when you did not have any sort of track record. How were you able to do that?
Well, like I said, I work with my mentor. So the mentor I was working with made sure I understand what it was I was getting into. My original goal, I was retired, I had decent money, but I was going to go out and buy a few rent houses, pay those off, following the Dave Ramsey school of thought, and live off that cash flow for the rest of my life. Have about 4 or 5 rentals maybe. But then talking to my mentor, they're like, well, why are you doing that? Well, that's all I know to do. And I don't even know how to do that. Like, well, why are you asking me this question? It's a bad idea. Like, okay, explain. Said, well, if you go into multifamily, it's easier, it's more rational. The overall returns are better. Your monthly cash flow on a single family rent home will likely be better, but the totality of your return in multifamily, when you consider a cash out refi or a sale, you're going to make a lot more money in multifamily. So I think you should go into multifamily. You have the time, the resources, and the intelligence to do it. So I listened, and that's why I jumped straight into apartment complexes right away.
How did you square that with the Dave Ramsey way of thinking? Because I know a lot of our listeners follow Dave Ramsey's method. Owning free and clear is an important thing to them. So it's really hard to change your mindset where you take on debt to acquire larger properties. How were you able to do that?
It depends on your personality and your mindset. I like his teachings. A lot of times, I don't mean this to sound crass, but what I've been telling people since I've figured out maybe a different way, Dave Ramsey is great for people that are financially broken or very, very, very ultra conservative. He plays a very big role in a lot of people's lives. Tons of value there. Again, I followed him. I liked everything he talked about. But then I started thinking that, look, I want more out of life than that. Paying off my car, paying off my house, calling in and doing the whole woo-hoo on his radio show. That's fun. But I got to go back to my W-2 cubicle job tomorrow because, okay, my house is paid off. But if I don't make my insurance, my tax payments, I'm still going to lose the house. So it's not a guarantee. What it did is it kind of trapped me, in my brain anyways, into I still got to go to work for somebody else that I don't like doing. I hate everything about where I work. I did it for a long time, but I was not real happy with it. So I kind of found what I feel is a better way. Take on debt, but safely take on debt, rationally take on debt. You can limit your downside to a fair amount if you go into this smartly. So I had to understand if I wanted a better life, I needed to start hanging around, listening to and talking with millionaires and billionaires. It changed so it was kind of a paradigm shift. Again, I still love Dave Ramsey, Susie Orman, all those people, Clark Howard. I still believe in those people, but it was time for me to move a little further ahead in my growth for me personally.
Take us through that first syndication you did and the different challenges you faced along the way. I know it really helped to have a mentor there walking you through it.
So never having done any of this before, I got myself educated and I was studying for about 9 months before I closed on my first deal, almost 12 months actually. And, it was a process. I was talking to somebody that was teaching me the ropes, how to do it, how to structure a syndication. But I went out and started my own meetup. Now, it's before I really even knew what meetup was, but I met a guy at a real estate function here locally. And I said, look, how about we get together every other Wednesday at a local Starbucks and we'll just discuss what we've learned or heard over the last week because we were both doing the same thing. We're at the same stage. Like, great. So we did that. And then when we would go to other real estate meetings and RIAs and different conferences, we would always talk to people there and say, hey, this is what we have going on. If you'd like to join us, you're welcome to. That group, within a matter of maybe 3 or 4 years, grew from the two of us to about 300 to 400 people. My first syndication came out of that group. All but I think 1 or 2 of my investors on that first deal came directly out of that group, including 2 gentlemen that were willing to sign for me on my loan. We had known each other for about a year. We got to know each other very, very, very well, but they understood I had no experience, no track record, but they got to know, like, and trust me because we spent a lot of time together. That's how I raised money my first time out without any experience. And yeah, I leaned on my mentor for the operational side of how do you pull together a private placement memorandum? What attorneys do you use? How do you negotiate the contract to buy this property I'm going to buy? But even all of that education, all the mentoring, you got to get out and you got to do it to really learn it. So I remember the day before we were scheduled to close, I called my mentor. She said, so how you feeling? You ready? I was like, I don't know. She goes, what's wrong? I said, I don't know how to do this. She goes, it's okay. I do. And if you'll listen to me, I'll make sure this goes as well for you as it can go. Things are always going to pop up, but I was smart enough to listen to the person that I had reached out to for mentorship, and it went really well.
What was it like when you were talking with your potential investors and approaching them for the first time? Did you send them emails? Did you call them up on the phone? Did you send them a letter in the mail? How did you let them know about the deal and the opportunity that you had for them?
So that's a slippery slope, right? So with the SEC, you have to do things a specific way or you're going to get yourself in a lot of trouble. So I would just organically meet people at real estate conferences and in organizations, RIAs, different things that I would go to. You just strike up a general conversation. You get to know each other organically. Hey, Bruce, what do you do? Well, I'm an apartment complex investor. Really? Okay. So do you buy your own stuff? So no, I'm a syndicator. Okay. Well, what does that mean? Well, I pull people's money together. I go out and purchase the property and I run the asset and deliver a return. Like, oh, well, that's kind of what I was looking to do or looking to invest in. So we kind of hit something there. So I tell you what, if you're interested, here's my business card. Reach out to me. We'll develop a relationship. So I have to develop a pre-existing relationship of substantive quality, right? So a pre-existing substantive relationship with an investor before I'm allowed to present my deal to them. So there is a courtship. I meet them at another meetup, let's say right now, or a real estate conference. I need to take some time to get to know those people before I present them with a deal because I got to make sure that they are sophisticated. They know what it is they're investing in. They understand the downside, the risks, all the things that can go on. And I got to make sure they like and trust me. If I like and trust them, but they don't like and trust me, we're not going to work together. So it does take a while before you're ready to present a deal to any prospective investor. But again, I would just meet them organically at different meetups and different functions and seminars that I would go to.
What were some of the surprises that you encountered in your first syndication? Other challenges, hoops you had to jump through that you didn't quite expect?
Honestly, it worked out okay, but I probably didn't raise enough money my first time out. My mentor was giving me a lot of guidance and direction, but I still think I probably, I bought a $1.6 million asset. I think I brought in like $30,000, $40,000 for rehab in a contingency. I probably should have brought in about $50,000 to $70,000 because there are some other things that I didn't know to look for necessarily that I probably should have raised money for. One of the big surprises that I learned the very hard way was when you buy an older property. This was built in 1984. So, it's got some age on it. When it was constructed, they had put in the fiberglass or plastic bathtubs. And over 30 to 40 years of use, people will get in their bathtub, stand in their bathtub. That thing will flex ever so slightly over 30 to 40 years. And eventually it starts to fail. And we had developed holes and cracks in bathtubs, but I didn't know to be looking really closely at those during my due diligence inspection period to make sure I really wanted to buy the property. So we have the property. About 6 months in, we start having bathtubs fail. The bathtub on our first floor fails. It's not ideal, but it's not the end of the world. We're having bathtubs fail upstairs. So when a bathtub fails upstairs, there's a slow leak that happens, and it sits in the drywall of the ceiling of the lower unit. And eventually you develop a bubble or a bulge, and it pushes, and finally it breaks, and you have water all over the downstairs unit now. So if I would have known to do the repair up front, it might have been $100, $200, but it was running me $1,000 to $2,000 now. And I had about 5 to 7 of those. So that was a very painful lesson that I learned. Be sure and look at your bathtubs.
That's the first time I've ever heard of that problem.
It's a real problem with your buying problem. Yep.
We've certainly had to reglaze our bathtubs quite a bit, and that can be expensive. But the failure, that's a new one. So how did you go to your investors, and what did you say about this bathtub issue that you had been unaware of up till then?
Well, we were fairly profitable. We were chugging along 8 to 10%, actually pushing closer to 12%. It's been some years now, but it was about 12%. And then I started having this stuff pop up. So we had cash flow to handle it because I had reserves that I needed for my safety net, right? For my emergency fund. And I'm not going to touch those to repair these bathtubs unless that's the only option. Luckily, we were solidly profitable. I could pay for it out of cash flow. But yeah, now I have to own up to that. I say own up, but now I have to disclose what's going on to the investors. I don't want to just say, oh, your distribution went down this month. Here you go. Have fun. I wanted to let them know why. Being my first deal, I was struggling with that. I was telling them what was going on, but it was hard because I felt I was letting everybody down. So I had some sleepless nights, and it weighed on my brain a lot. But they were very, very understanding because again, we had developed a deep relationship before we got into a deal. So they knew me. They knew when I brought it to them and say, look, I'm sorry, this is not going the way I expected it to right now because these bathtubs are killing me. Bruce, it's okay. We understood when we invested in you, you had never done this before. We knew what we were getting ourselves into. And that goes back to, again, I knew who was going to invest with me. I knew that these people had the stomach and the mindset to be able to withstand some of these short-term issues that we're going to go through. So I disclosed it, they accepted it well, and we just moved forward through it.
Yeah. And by the way, anyone who's ever syndicated knows that at some point you have to go to your investors and say, the unanticipated happened and we're going to have to allocate some extra money to it.
Yeah.
You do have to be able to break bad news to your investors. What other unpleasant news have you had to share with investors?
Well, we've had to, talk about the dead guy we found in a pool one day, the arson on a property. We've had to talk about the day we were trying to close on a property, a 250-unit property in Central Texas. The day we went to close on it, I wired my $5.2 million in to the seller, and I headed to the property waiting for the all clear to go on property and take over. Well, the wire never showed up. Like, what's going on? So I started calling around, asking around. Talk to the title company, talk to my bank, talk to my attorney, talk to their attorney. Nobody's seen the wire. Nobody knows where it is. And I had to leave that Friday instead of having a brand new shiny toy that I could say, hey, celebratory email to the investors. We have our new property. And now the fun starts. Well, I had to come back now and say, hey, we didn't close. I'm sorry, but I'm going to do you one better. I don't know where your money is either. So I had to explain to the investors that $5.2 million of their money, my money also, I had $100,000 roughly in that deal, but $5.1 million of it was not my money. And I had explained to them that I don't even know where it is.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. So it had just evaporated into thin air. The bank didn't know where it was. It was just
was gone. And you hear horror stories about wires being intercepted by bad people and taking your money. I was like, oh my Lord, I'm ruined. I've got $5 million that I can't just go write a check for to cover this. So luckily we figured out later, because the president of the title company had dealt with something like this about 10 years prior. And he finally said, this reminds me of another issue a long time ago. So he made some phone calls. And what had happened, there's a division of the U.S. government that is responsible for keeping an eye on wire transfers that go around the country. And they're comparing the sender and the receiver to a database of known bad actors internationally. And when they ran the two parties through their system, their database kicked back that the name of the property that I was buying was the name of a known Colombian drug cartel, I believe it was. And so they thought this might be that group. So they grabbed my $5.2 million while they legally have 2 weeks to research this thing. But they don't have a customer service department to say, dear Mr. Petersen, we have your money. And we'll have it until we figure. They just took it, didn't tell anybody. I'm like, what the hell's going on? And so, like I said, I had to come back and explain it all to them. But that happened on a Friday. And then by Monday, we got it cleared up and we closed on time. But again, lots of white knuckles, lots of stress and accountability there, right? So that's why the book I talk about, most people I firmly believe should not do what I do. It's really, really hard. And a lot of people get seduced by the potential earnings, which they can be very good. But there's a lot of stress, a lot of liability, and a ton of work that goes into these things.
All right. So you have to tell us the name of that apartment complex and why it was flagged by the United States government.
It's called Vizcaya, Vizcaya. So the learning lesson there was file your DBA paperwork after you take over. If I hadn't have jumped the gun and filed my DBA paperwork about 2 weeks before we take over, they would have never seen that name. It would have just been the name of the entity that owns the property, not the property's name itself. So again, I learned a valuable lesson that, first of all, if this happens again in the future, I kind of know what's going on, so I don't stress out so badly, but also file my DBA paperwork after we take over, and we should be fine.
And you talk about the stress of syndicating and how it's not for everyone. Tell us who syndication is not for. Who should not be syndicating?
It's for people that aren't confident, aren't good communicators, and don't have at least some degree of tolerance for risk. Because this is business ownership. And that's what a lot of people, they get sucked into this belief that real estate is different. It's special. You can't lose money. It's easier. It's recession proof. It's all this stuff. And then within real estate, well, multifamily is even safer and more rational. Well, within that, now you're going to do a syndication. Well, a lot of it's not even my money. Well, that's just more and more layers of complexity and stress. So you get seduced by the dollars that you hear people talk about on stages all the time and at different events you go to, but you don't understand that, look, I'm going to have to make some very, very difficult decisions. I ask people all the time, okay, you want to do this. Can you fire people? Have you ever fired somebody? And no, but I could. Are you sure? Yeah, I'd be able to do that. Oh, okay. Well, how about, well, sometimes I'll say, well, but I'm going to have a third-party property management company, so I won't really have to fire anybody. Well, if they're not good, you'll have to fire the property management company. Okay. Can you fire an investor? Like, what? Like, yeah, really? Can you fire an investor? If there's some, you're going to do it with tact and be very respectful. But if you're talking to somebody that you've gotten to know and you start to figure out as you're coming down to the finish line to close on this property and they start changing or you're seeing a different side of them now that real money's involved, and you think, oh, you know what? They really aren't a good fit for this. You have to make that decision and say that. Look, Mr. or Mrs. Investor, love you to death, but I don't think this is the deal for you. There are plenty of deals out there, but I just don't think this is a good fit. So I wish you the best of luck. And here's your money back. So if you can't do that, if you can't fire an employee or a management company or deal with an investor that you think is not a good fit, this is not for you. So you have to just be very transparent, get out in front of problems when they arise, because they are going to arise, and you need to be able to stand up for yourself in your partnership.
And what are the qualities that you have that make you a successful syndicator?
Well, I think I have extremely high EQ, so emotional intelligence. I think I have a very good ability to figure out what's going on behind the scenes, if you will, behind their eyeballs, right? They're going to, like when you're in an interview or on that first date, people are going to say and do things that they normally wouldn't do because they're trying to make a good first impression. I'm really good at seeing through that stuff, but I'm also really good at understanding what people need from a leadership standpoint, like I have my own management company. So I understand how to effectively manage each individual personality. So I think that's probably my biggest, if you will, superpower, like a lot of people are saying nowadays. That's probably my biggest superpower is I have incredibly high EQ. I understand how to interact with people, and I think I'm a very, very good communicator.
For those who are first-time syndicators or thinking of getting into it, what do you recommend that they start with? I mean, how do they get into syndicating? And you started by finding a mentor. What else do you recommend?
So yeah, the mentor is huge. A lot of people, there's a bad word floating around about mentors, and a lot of people are calling them gurus. And find somebody that's done what you've done before. Look for a model to, I think it's a Tony Robbins word. Look for somebody to model yourself after. But after that, if you know that you want to syndicate, you got to get out and start meeting people. And a lot of people say, but I'm not really good at networking at events and going up and, doing the politician thing, shaking hands and kissing babies. That's not my thing. Well, either it's going to have to be your thing. You're going to have to figure out how to get past that, or attach yourself to somebody that has that skill set that can get out there and network with or for you. But bottom line, you got to start meeting people. The rule of thumb that I use is, let's say you're going to go buy $1 million asset, and it's going to cost you $300,000 in capital to purchase that between down payment, closing costs, rehab, and operating capital. You're going to need $300,000. Well, you'd better raise $600,000 to $900,000, right? Because when it's time to actually present these people that you formed this relationship with, present them with a deal, there's a very good chance that most, if not very many of them, are not going to have the money when it's time to go, because they're going to have a personal thing that's come up. They'll have another investment that's come up before yours came up. So they've diverted their capital to somebody else. So again, you got to get out. You got to start meeting people, raising. It's a soft commit in your raise. If I find something that fits all of your boxes, Mr. or Mrs. Investor, how much would you consider investing? A lot of people aren't comfortable asking those questions either, because we've all been taught, don't talk about money. You can't ask people about money. Well, you have to in this business. So get out there, raise money, soft commits, network with as many people as you can, get a high quality business card, carry yourself with confidence, have an elevator pitch ready when you meet these people, know what it is you're trying to buy, where you're trying to buy, just have everything as tightened up as you can, and then go raise money and then find your deal.
Now, one of the things you talk about in your book is starting with a plan. Can you explain what that means? What kind of plan are you talking about?
So again, the plan is, what do you want to buy? Where do you want to buy? If you're going to buy, if it's your first deal, or maybe even your first 2 or 3 deals, I highly recommend buying it right down the street, or as close to right down the street from where you live as you can. Because you need to be able to see that property. Even if you're going to hire an outside company to manage it for you, which probably 80% of people will, you still want to be able to eyeball the property. Make sure that they're not just sending you financials, but the property's really burned to the ground and they're just falsifying all the financials. You need to make sure that that thing is still going well. So until you get a lot of systems and processes and procedures in place, you're going to need to go on a fairly regular occasion. So have a plan. Decide where you want to own. If you live in a town that has 200 people, well, hopefully there's a town within a half hour to an hour that has a few 100,000 people. That will work better. But also, remember, you're out there raising money. You need to be talking to these prospective investors. If I do find a deal and you do like the deal, it comes down to return. Do you have a minimum return requirement before you would consider investing in a deal? And if everybody that you're talking to says 6 to 8%, but the deals that you're finding are 2 or 3 and 4% returns, well, you can find those deals all day long. Get excited about them all you want. You send those out to your prospective investors, and they go, well, no, I'm not going to accept that return. I need a higher return to invest with you. Well, you've wasted a lot of time. So have that part of the plan figured out. You want to own probably at a place that has job growth, wage growth, population growth. You want a place that people want to be, not graduate high school and run away from this, podunk town as quickly as you can. Also, I firmly believe you should not be overly reliant on any one employer or industry. So there's a checklist of things that you want to go through creating your plan. How much money do you think you can raise? What kind of a property do you think you want to buy? Do you want to buy in the hood, where you have lots of dogs running around off leash with cars on blocks? Your potential return might be higher there, but your risk and stress level is going to go through the roof. So you need to kind of dial in what it is you're looking for, where you want that to be, what kind of money you can raise, and what the expectation of return is for those investors.
And you also spend time talking about building your team and the types of team members that you need to have when you're syndicating. Can you share some of that with us as well?
Absolutely. So, it's the cheese ball thing that everybody says, life's a team sport. Well, it's true. Everything is a team sport. You can go out there and try to do this yourself by crafting all your own legal documents, going on the legal Zoom, having all your bookkeeping, not even bookkeeping, but your tax returns at the end of every year with H&R Block or somebody like that. That's a horrible idea. It's okay if you work at 7-Eleven. It's not okay if you're going to run a multi-million-dollar real estate enterprise. So you need to start gathering names and having, interviews or coffee with a real estate attorney, a syndication attorney, a bookkeeper, an accountant, all these different people that are going to come into play in your world. And the best way to do that, really, because you're not going to know any of these people right away, all of these places you're going, all these meetups, all these real estate conferences and RIAs and all of that, you need to be asking around. Okay, so you've done syndications. Well, who did you use for your real estate attorney? Who did you use for your bookkeeping? Ask these questions because you really need to have a lot of these people identified before you start your search. Because once you find a property, a lot of times it's too late to try to find these professionals now. You have a definite clock ticking on. You have between 20 and 30 days to decide the property you just got under contract. I indeed really do want to try to close on this property. So again, have those people identified early on and reach out to people that have done what you're trying to do for referrals. One
of the questions you ask potential syndicators is, have you ever fired someone, or could you fire someone? Could you have some of those unpleasant conversations or situations and handle them? I'd love it if you could share if you've ever had to fire anyone and why, or any unpleasant type situations that you could share with us and tell us how that went down.
Yeah. So if they're listening to this, I'm going to, hide names to protect the innocent, that kind of thing. I actually let one in, and great guy. I've known him for years, and everything's going really well. Well, suddenly his spouse kind of took over the investment portion of their life. She doesn't know anything about real estate investing. And I'm like, okay, well, that's fine. It doesn't matter. Well, we started getting all kinds of questions from this spouse, that just were completely off the wall. That like, how is this even a question? Why are you asking? It makes no sense. So multiple questions. It's like, look, I don't have time to teach you how to invest in real estate. Your spouse knew how to invest in real estate, but suddenly he's out of the picture. So now I'm dealing with you, which I'm totally glad to deal with you. But you don't know anything about what we're doing here. So I finally had to call the husband, who I knew very well, and knew that he knew real estate investing. I said, look, man, I'm going to do this as softly as I can. But can you have her ask you the questions first? And then if you still don't have the answer, then by all means, reach out to me. But I just don't have time to put them through a real estate education course. I don't have time for that. That's not the deal here. So it wasn't fun. He was very understanding, but that's a nerve-wracking conversation. You don't know how he's going to respond to that. Oh, no, you think my wife's an idiot? No, but you don't know how it will be taken, but it was taken very well. But again, it's something that had to be done because it was driving us nuts. And we just didn't have time to deal with that stuff. So, there's things like that. They're going to pop up on probably every single deal you have. You have to be able to tactfully establish boundaries, if you will. And when we're going into a deal, we always do webinars, right? This is the deal we're looking at currently. Understand, guys, when you invest in this deal, it's a business. Things can and will go wrong. If we have a weird quarter because we have a hurricane or a tornado or a fire, and I can't send out a distribution of cash flow for 1, 2, 3 quarters. COVID-19, right? I can't send out a distribution right now. It makes no financial sense for me to start sending cash out of the company when we don't know what May and June are going to look like for rent collections. I tell them in these webinars, if you can't start long-term, we're going to be fine. We're going to make money. But these short-term gyrations, if you can't handle that, please do not give me your money. So we try to head it off the best we can at the beginning.
So how are your investors handling the fact that they probably didn't get first quarter distributions, and you can't really tell them, or maybe you can, but at this point, we don't know enough to know when they'll start seeing those distributions again?
Yeah, so that's never fun. They invest money expecting a return. And I had to tell them that, look, I can't send anything out. There's just no way. I did have a few, and they were very polite about it, but I could sense concern in their emails and their phone calls that, Bruce, well, can you maybe send out half of a normal distribution? Like, look, man, I'm so sorry. I can't. I have a fiduciary duty to this company, not to an individual investor. And that's the hard thing. You have to have those conversations, but you have to do it in a way that shows that person dignity and respect. That, look, I'm so sorry you're going through what you're going through. I can tell that, you're concerned. I can't take a chance of having this property go upside down. Because if I send too much money out or any money out right now, where you realize a month or two down the road that I should not have sent that out, I really need that because people aren't paying their rents. Well, now I got to go out and ask the investors, I need more money to keep us afloat. Well, you're telling me that with this conversation that you're not going to have the ability to contribute more money later if that comes to it. So I can't send money out. That's only been about 2% of our overall investors, but we explain it to them very politely again. And I keep saying that, but you just got to show people respect. But just let them know, I can't. And I don't know when we're going to be able to send out distributions again. And hopefully in the next quarter or two, we'll get back to normal. But we will, play that by ear, and we will stay in complete communication with you. We're letting them know what the collections are like on a monthly basis, how we're looking, and what we're doing to try to make sure that we do collect rent. But yeah, it's not fun. You got to explain it to them.
So tell us a little bit about your book. Why did you write this book? Who's it for? And right now we're recording this April 27th. The book comes out May 5th. So by the time people see this, the book will already be out. Tell us, where they can find it as well.
So the reason I wrote the book, it's weird to say it this way, but I was tired of going to real estate events and conferences and seeing the dog and pony show that was going on stage. You've got a 2-day weekend event. Some traveling guys come through your city and say, hey, come out for a free event. Well, it's a free event. Yeah, but they're trying to sell you a $30,000 to $50,000 to $100,000 education or mentoring program, right? Most all of them, first of all, I know most of the people that run these, and most of them are great people. They're very good people, and their product is very good. But at the same time, they have an agenda. They're trying to sell their program to you. And if they have somebody like me come up on stage and tell you about the dead guy, the $5.2 million going missing, the arson, the tornado that ripped down buildings, and the drunk driver that ran through my property, people are going to go, oh, the dollars are great, but I don't think I want to do this. That's a lot of work. I don't think I have the stomach for that. So I wanted to write the book and give a step-by-step guide as to exactly how to do a syndication. But I also wanted to tell some stories along the way to make people understand, look, it's not all rainbows and lollipops. Things are going to go wrong. And if you can't handle that, you probably shouldn't do this. And so 2 or 3 different places in the book, I actually say, look, if you read this book and you decide, I want no part of doing what I thought I wanted to do, I think the book has been successful. I'm not trying to gain clients. I'm not trying to gain mentees, right? I don't offer a mentorship myself. Someday maybe I will, but right now I don't offer any of that stuff. I'm just trying to make sure people get into this with their eyes wide open and they realize, okay, I understand the warts and the scary stuff. I still think I'm cut out for this. I really want to do this. Fantastic. But I know most people shouldn't. And I'm trying to help people get into something that they realize later that I probably shouldn't have done this.
On the one hand, you want to help the reader not have to spend money on a guru and their training and, give them an indication of what syndication is about. On the other hand, you had a mentor who did walk you through at least your very first syndication. So what is your feeling on mentorship or coaching and paying for that type of training or that type of service to get through your first syndication deal? So
I'm not trying to talk them out of it at all. What I do actually in the book, when I get to the part of the book where I break down the step-by-step guide on how to do it, the first thing I do is say, get a mentor. I just don't want them to give somebody $10,000 to $50,000 of their money with the wrong expectation, not knowing that, oh, this is going to be hard. It's not going to be fun sometimes. But no, I firmly believe you should find a mentor. I don't like the word guru. It's got a very negative connotation. But yeah, I did. And I think everybody should. If you make a mistake in a single family rent home, it might cost you $10,000. You make a mistake in an apartment complex, it can cost you tens of thousands, if not hundreds of thousands of dollars in loss. So I really believe you need a mentor to do this. I want to show you the steps involved. But a book is only a book, right? It can't, there's things that are going to pop up all the time on your journey that weren't covered in the book. It's impossible to cover every eventuality. So I really believe you do need a local mentor. Hopefully you can find one at one of these local meetups that's willing to do it for you for free. Most of us aren't willing to do it for free. We don't have the time. It's very time consuming to help you. And we have our own stuff going on. So I don't think there's a problem with paying somebody these $10,000 to $50,000 fees, but understand they're going to show you a process, but it's still a lot of work and it's very, very hard.
Absolutely. Any parting thoughts or advice for our listeners who have been thinking about syndicating and are still on the fence as to whether or not they want to do it?
Be self-aware. If don't lie to yourself. Oh yeah, I can do that. Can you really? Because you're going to have a lot of people on your shoulders financially, depending on you for their return. And just be real with yourself. There's nothing wrong with investing in somebody else's deal and finding the thing that really does work for you. But if this really is for you, well, then jump in with both feet. Don't be scared. Find somebody to help you along the way, in addition to reading this book. But get out there and do it. Trust your skill set. I was a retail guy. I knew nothing about this. But when my mentor put it to me straight and said, look, you have led people, it sounds like, your whole life. Well, I have. Well, that's all you're doing here. You're leading people. You're holding people accountable, a management company or a staff. It's nothing different than what you've done before. You just need to learn this industry now. So I had to be convinced that I had the skill set to do this. And many of the readers are going to have the skill set to do it. Again, it comes down to, do you have the intestinal fortitude and the tolerance to deal with what you're about to get into?
Bruce, how would our listeners get a hold of you or find out more about you?
You can go to the website. It's currently under reconstruction, so it's not ideal right now, but about another week or two, it'll be up properly. So it's apt-guy.com. You can follow me on Instagram at apt.guy.com or Facebook, The Apartment Guy, The APT Guy is where you'll find me on Facebook. You'll be able to follow along everything that we're doing when the book comes out, all the different things that we may offer in the future. Or if you just want to say, hey, I'm thinking about this, what do you think? I don't mind talking to people at all. I'll take any phone call that comes my way. Well,
the book is called Syndicating is a B, rhymes with which, I'm not going to say it, and Other Truths You Haven't Been Told. It's a great...
I'll cover up the first part.
There you go. That's it right there. I don't even need to say it now. I read the book. It's a great... it takes you through A to Z about syndication. So it's an enjoyable read. And I think if you haven't syndicated before, or even if you have, it's definitely worth checking out. Bruce, thanks so much for sharing all of this with us today. It's been a real pleasure.
Thanks for having me. I had a ball.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.